Can anyone confirm if you can hear me?
Yes, I can hear you. I can hear you. Good evening.
Oh, great. Thank you. Thank you for that. Thank you very much.
You're
Okay.
welcome.
Yeah. Let's continue audit planning. So what is audit plan? Audit plan. Before now, I expect that we have gone through the video notes or our notes, our materials, whatever we are using to prepare. So we just review it together, study together. Any gray area that is not clear, please ask your question. That is the essence of this class. Thank you. Okay, audit plan. Audit plan. It's not different from what we know. Plan is a plan. We just relate it to audit. It is a strategic document in audit in it because it's so important. It's so important in every as an organization, as an audit firm, you have a system or procedure for developing audit plans, and for each assignment, you also develop audit plan. It can be generic and might not be generic because of what we know that companies are different, industries are different, so audit plans are also different. But generally, what do we mean by audit plan? Audit plan, just like we know, is a document. You just define plan and just relate it to audit. A plan is a course of action that will prepare to achieve a stated goal. So also audit plan is just the statement of actions to be carried out in order to ensure the audit is conducted in the manner specified by the appropriate standard and to achieve the objective of auditing. So what is the overall objective of auditing? According to international standard on auditing, ISA 200, talking about the overall objective of independent auditor and the conduct of audit. The major objective, the major objective of auditing is to obtain reasonable assurance about whether financial statements are presented in a way that reflect the true and fair position of the financial statement. There is no material misstatement, whether due to fraud or error. It's so simple. And another objective is to report on the financial statement so that the users of the financial statement can obtain reasonable assurance and they can make informed decisions based on that. To achieve this objective, the auditor is expected for every audit to comply with all the international standards that are applicable. I guess you understand that not all standards is applied, but the auditor has the responsibility to understand, to be able to apply the standard that is applicable to a particular situation, in as much as you're not going to be auditing a particular industry. And even in a single industry, time evolves, things are changing, standards are being reviewed, new standards are being released. So it is the responsibility of auditor to be familiar with the standard. And this, according to ISA 200, there is an obligation on the auditor to comply with all relevant standards, also to comply with ethical requirements, and be professional in the performance of the exercise professional judgment, in planning and performing audit so as to obtain reasonable, appropriate, and sufficient audit evidence. You can see the way it's related. Audit plan and the objective of ISA 200, because this guide the planning that you make. You plan to achieve an objective, right? So what is the objective? The objective is what IC 200 is talking about. Again, you make plans to achieve objective. What objective? The objective is what ISA 200 specify, and is to obtain reasonable assurance about whether financial statements are free from material misstatement. Bearing this objective in mind, it will inform the auditor the kind of preparation to make. And when you just think about it generally, that you cannot apply the same plan in every situation. You cannot apply the same plan in every situation. So what this implies is that your plan has to be reviewed and has to be relevant to the kind of audit you are undertaking. I hope that is clear. The plan is needed. So if you are asked the purpose for audit plan, it's simple. The purpose for audit plan is to be able to achieve the objective of auditing, overall objective of auditing. You have to plan it very well. In an industry with high risk of fraud, to obtain a reasonable assurance, it means you are going to plan in details. If you are auditing in an environment that is not that risky, it tells you that to obtain reasonable assurance, the kind of plan you're going to make will be different. For example, if you are auditing a bank and you're auditing a bakery, you are clear that your plan will be different. You're auditing, let's say, a medium-sized bakery, or let me say a bank, microfinance bank and commercial bank. Commercial bank is big, microfinance bank is relatively small. The kind of plan, starting from the qualification of the team member, they are going to be different. So what is informing the plan? The objective of ISA 200 is what is informing your plan. If you have this in mind, that the requirement of this standard is that the auditor must comply with relevant relevant standards to the audit. There is a standard for commercial bank. There's also a standard for microfinance bank. Given this simple scenario, you understand that the plan will be different. So what informs the plan is the objective. That is why maybe when you are reading, you might be wondering what is the relationship between this and this. So they are related. You plan to achieve objective. What is the objective? The objective is ISA 200. And you understand what the standard requires. So let's go to planning audit proper. Planning of an audit. What are we auditing? Statutory audit, audit of financial statements. There's a standard, ISA 300, is specifically designed for planning and audit of financial statements. So what does it say? The standard states that the auditor should plan the audit effectively. The auditor should establish overall audit strategy, and the audit plan should include measures for direction, supervision, and review of audit work. ISA 200 and ISA 300, you can spot the difference. ISA 300 is specifically for planning the audit. Generally, why do we need to plan the audit? We plan the audit to achieve the objective of ISA 200. You can say the relationship. So, let's audit strategy according to ISA 300. That says that auditors should establish overall audit strategy. What is this audit strategy? Before we even go into details, you can guess what it is with the simple scenario I depicted. But let's look at it formally. In practice, like in audit frame, the auditors prepare audit strategy memorandum. It is a document that states the points involved in a planning process and the key decisions that have been taken. What are the elements of the audit strategy memorandum? In the memorandum, you will see the assignment of objective and reports to be issued, audit timetable, that is, when to the time needed to complete the audit and when the report will be available, will be ready. In the memorandum, we also make provision for changes in the client's organization or business affecting the business since the previous audit. This part is, you can say, is particular about a firm that you have been auditing, even for a new engagement. Peradventure, you just got a client, but you remember that from, I think we discussed this last week. If you are getting a new client, you because professional ethics requires that you communicate the previous auditor, and the previous auditor supposed to brief you on the status as at when the previous auditor was auditing it. So the previous auditor has a responsibility to hand over the document to you. Through that, you can carry out an assessment of changes in client's organization since the previous audit, regardless of whether they are the one that audit is or not. Then in the memorandum, the summary of financial ratios or other ratios from previous years. I think when we get to audit proper, you understand why this and then, but for now, let's just look at the content. Then planning decision for the audit, attendance, location. If the client has more than one location, because he has to visit all the location. The staff requirement, that has to be there. Method of communication, that has to be stated formally. Okay. So let's look at the information required to effectively plan an audit engagement. Right, getting deeper practically. ISA 300 require auditor to prepare audit strategy and audit plan. In essence, this standard is supported by ISA 315 that says identification of the risk of material misstatement through understanding the entities and its environment, so that the auditor can have a sufficient understanding of the environment and the entity itself in order to understand the risk of material misstatement within the client financial statement. This standard, what this standard 315 is talking about, is very relevant. That is why they relate it with IS 300, because if you you have studied the client's environment, you study the client performance, the financial statement, you have understanding of the approach to use, You have understanding of the risk involved. This will inform your strategy, and this will inform your planning, effective planning. I hope you can find the link. In order to satisfy that, the requirement of both the ISA 300 and the ISA 315, the auditor need to access a wide range of information. Because when you are planning, you don't plan in vacuum. You plan based on information that you have. You plan based on information, things you know about the company. So in planning, for example, you just got a new client in a new sector that you have not worked before. While planning for the engagement, it is necessary to follow the requirement of ISA 315 because you need to understand, especially this is a new environment. How do you audit it? This is an environment you do not know. If you are not careful, there might be liability coming from it. Because each industry are peculiar and they have their regulatory framework that the auditor needs to be aware of and factor it in planning the audit and if carrying out the audit exercise. I hope that is clear. If there's any question, please let me know. So if there's any question, just let me know. Information required in planning. You might need obtain a copy of new loan agreement with the bank to ensure the details of overall overdraft. You review the legal correspondence between the client and the advisor. You review the details of significant new sales contract. You obtain a copy of prior financial statements in order to review the accounting policies. When auditing, all this, you collect a lot of information. Like I said last time, you have the right to ask any information that you feel might be needed. And it's your responsibility to supply those information. Before the audit, all these financial statements, when you collect financial statement, you see some transactions, you ask for the details. Even before the audit, you are preparing for the audit. You have not gone for the audit, but in preparation, all this information has to be gotten, study them in details, then use it in your planning. Any question so far? I guess there is no question. I can continue. Okay, let's continue. Uh let's look at the risk-based approach to auditing. The approach to audit, you can use look at risk-based approach. What this approach is talking about, that you want to plan the audit from a perspective of reducing the risk, assessing the risk. You anticipate risk, and because of that, you are making your preparation based on your level of risk assessment. This is what informs your planning, and you are developing your planning using risk-based approach. This approach might, okay, there is no OBJ. This approach is guided by ISA 330. You don't bother yourself with ISA number. Just understand what it means. In case you were given the scenario, you quickly understand that, oh, this is the standard you are talking about. but it is cool if you can identify the standard number with the definition. It will be perfect. At the planning stage, ISA 300 and 315 require the audit to identify and assess the main risk associated with the business to be audited. That is explanatory. I've explained that before. The auditor will need to design and implement responses. So the planning approach will be in response to the assessed risk in accordance with ISA 330. So let me relate them again. ISA 200, ISA 300, ISA 315, ISA 330. They are related. We are talking about audit planning. Generally, what is planning? Planning is course of action to be taken in order to achieve an objective. Related to audit, audit planning relate to the steps, the strategy, the actions taken in order to achieve audit objective. What is this audit objective? ISA 200 specify explain overall audit objectives, that is to obtain reasonable assurance that the financial statements are free from material misstatements. This is the main objective. To achieve this objective, there are steps to be taken. To achieve this objective, it means to the auditor that the auditor needs to plan the audit work accordingly. And that is what ISA 300 is saying. To plan audits accordingly, you need to be able to understand the business that you want to audit, you understand the environment that you want to audit, and obtain reasonable information, whether new client or old client. To plan audits appropriately to achieve the objective of ISA 200, the auditor need to follow ISA 315, which says the assessment of risk associated with the business. And in planning the audit, having understood the responsibility given to the auditor by ISA 200, following the standard of ISA 315, the auditor can adopt risk-based approach to plan. And the risk-based approach to plan, what is it saying? It's saying that you have assessed the risk associated with the business, with your client's business, the environment, and you develop a plan in response to the risk assessed. This implies that if you have assessed a risk in the business to be high, then your response should be in commensurate with the level of risk. If the following year you review the risk, you assess the risk again, and the risk reduced, it means your response, your plan, your strategy to audit in the following year will change. So if you're applying risk-based approach to planning your audit, it's going to be dynamic. You're not going to be straightforward. For example, if you are auditing a bank, let's say one bank, First Bank, it's your company that has been auditing First Bank. If you are following risk-based approach to planning, you cannot use audit plan of previous year to audit this year because of the approach you are following. You would have reviewed the risk assessment. It is the result of the risk assessment that will inform your plan. I hope that is clear. Yes or yes? Please let me know if you are following.
Yes, we are following.
Thank you very much. So ISA 330 is talking about auditor's response to assessed risk. There are two responses. We have overall responses, then audit a procedure responsive to the assessed risk of material misstatement at the assertion level. However, irrespective of the assessed risk of material misstatement, the auditor needs to design and perform substantive procedure for each material class of transaction, account balance, and disclosure. The auditor also needs to consider whether the confirmation procedure are to be performed as a substantive audit procedure or not. The risk-based approach to audit enable auditors to conclude whether the financial statement reflect true and fair position of the statement. Audit risk model. Audit risk model for assessing risk. Because this, if we are applying risk-based approach, this is the beginning. You have to be able to assess the risk. So the model, the standard audit model, is available to help auditors to identify and quantify the main elements making up audit risk. Audit risk, what is it? It's the risk that auditor will give inappropriate opinion. Is possible when the auditor is supposed to say no, because life is a risk. So the auditor is also prone to making risk. So the risk there is audit risk, that the auditor will give wrong opinion. Example, if the audit risk is 5%, audit risk is 5%. We are saying if the auditor says yes, there's 95% assurance that it is yes. 5%, it's 5% that it might not be, but generally 95%, the opinion of the auditor is okay. It means the auditor score 95 over 100. It's still a pass mark. The audit process is designed to give high level of assurance. 100% assurance that, oh, the auditor says the financial statement is good. That is perfect. But human error, we are all human beings. That is why some level of significant what is it called in economics? Significant level of 5% is allowed. Okay, but high level of assurance is better, 100%. That the information presented is okay. The application of this is that auditor will seek to reduce the level of audit risk to a acceptable level, but will not attempt to eliminate the risk entirely. Audit risk. Audit risk in the audit risk model. Simply, what is audit risk model? Audit risk model is just what composed of audit risk. We have inherent risk multiplied by control risk, and then multiplied by detection risk. There are three risks in the audit risk model: inherent risk, control risk, and detection risk. Inherent risk and control risk, they are categorized as financial statement risk, and the detection risk is the audit control risk. So audit risk model is simple, just the three elements that makes the total audit risk and the interrelationship. So what is inherent risk? Common English, inherent. Bedrock is the risk that item will be misstated as a result of inherent characteristics. There's a risk because the auditor is expected to carry out an audit to give opinion that, oh, financial statement is free from material misstatement. But then there's a risk that the auditor will not see all material misstatements. There's a risk that the auditor will not see, will not review, will not discover all the material misstatements. If we are working class and here we like in my office, we used to say that, and the auditors audit this place. They said they audit what they are auditing. They did not do anything. We are still seeing mistake. What is the essence? These are the risks. The auditor will not see everything. His audit risk will not see everything, will not dictate everything. There are some that are natural. These are inherent risk. The risk that there is nobody, even if you bring Jesus, Jesus will not see the material misstatement. Those things are inherent risk. Where can they act? How did they develop? Inherent risk develop sometimes based on the nature of the business. For example, let's say in oil and gas, it's the oil and gas, for example, and they know the nature of oil and gas. They dig, they have tank in the oil, they have fuel there. Auditor might not have skill to go into the tank, for example, to see now, oh, the tank is full. The auditor will have to rely on the machine. There are some instances that the auditor, based on the circumstances, the nature of the business, the auditor might not be able to see it. Because of that, the auditor might just say, oh, I see a tank, it is covered. It is covered. Because of that, I say there is oil in the tank. Full. Perfect. Meanwhile, it is water that is there. It is not the profession of auditor to detect the difference between water and fuel. What if the fuel is mixed with water? The auditor is not in line in that profession. Okay, so this is because of the nature of the business. Maybe the rain fall, the water mix, the flood, whatever. This is not human error, but nature of the business. The auditor might not be able to detect, oh, there's a risk of material misstatement. Maybe the inventory should have been 50. If the auditor have had access to the underground, but because of that, the auditor said, yeah, the inventory is 100. This is a material misstatement. 50 versus 100. This is a risk. Another area where inherent risk can come from is the nature of the entity and the industry in which they operate. There are some industries that are very volatile. Let's say stock, investment companies like that. They did the stockbrokers, insurance, health industry. Due to the nature of the business, of course, there might be high risk that are just peculiar to that industry. So that is inherent risk. When inherent risk is high, this means there is high risk of misstatement of an item in financial statement. You can agree that we know that control system in that environment is beyond what auditor can do. It's beyond the power of auditor. Then it is also possible that the auditor, there's a risk of material misstatement. This aspect called the attention of auditor. If you are auditing, it is allowed to state it in your audit report that because of so and so, this opinion you are giving, you qualify the opinion so that you save yourself. You don't say because the environment is high. They all know if you want to invest in it, you should apply your sense. No, you are a professional. You should understand. That's why you should assess the business environment. If such things are found that, oh, this business is highly risky, for example, forex or cryptocurrency, yes. And some people are buying crypto, investing in forex because big for PwC said the companies has been generating profit over 40 years. But we all know that that industry is highly volatile. But I can say, the auditor has said this, I'm going to invest my money. If I lose my money, I can charge the auditor. That is why the auditor will need to assess there's a risk in this industry. You cannot say you have profit of 5 million. No, don't declare 5 million because this industry is volatile. There's a way they do it. Apply accounting skills in it to report your business. You understand the inherent risk and how to deal with it. Let's look at another risk. Please read more on it. It's so much. Because of our time, just let's look at control risk. Control risk is a risk that misstatement will not be prevented or detected by the internal control system that the client has in operation. The auditor's responsibility is to report, but to prevent fraud, it is not the auditor's responsibility. It is the responsibility of the company's directors to prevent fraud. It is not the auditor's responsibility. Now, control risk is saying that material misstatement will occur because we are not the Messiah. The auditors are not the Messiah. Oh, because the internal control system is weak. Based on that, there's a risk of material misstatement. And this control risk is very reasonable. You can just think about it. The auditor, the maximum time period to audit a company, let's say the worst, it can't be more than, let's say the worst, 3 months. A job that account, financial statement that they're auditing was prepared based on a full year statement, a full year calendar year. And you expect auditors to dictate what you use 1 year to do in 3 months. It's not possible. If the internal control system is weak, there is a risk, control risk, that material misstatement cannot be detected by the auditor because the internal control system is weak to prevent and detect the material misstatement in the organization. In preparing an audit plan, the auditor needs to assess control risk for different areas of the audit. But as we go on, we will see the relationship between internal control system and the audit. They have relationship. Practically, when auditor goes to the client's office, if they have internal audit department, their first contact is internal audit department to understand internal control system. They get the internal control system, the internal control policy, the company's policy, assess it. This is this policy that the company state. Is the policy effective? That is what. How are they applying the policy? You test it. That is where auditor touch every aspect of the company, including the driving department, the technical, the check, because they need to assess the control risk. Otherwise, the overall audit risk is going to be affected. I hope that is clear also. If there's any question, please let me know. This is interesting because we are getting into the practical aspect of audit. If you have any question, please let me know. Okay, let's go to the last part of the audit model, the detection risk. This one concerns the auditor itself. The detection risk is that the audit testing procedure will also fail to detect material misstatement, either in a transaction or in account balance. For example, if the detection risk is 10%, this means that the auditor scored 90 over 100, there is 10% possibility that they will fail to detect what they are supposed to detect. That is detection risk. Detection risk can be lower by carrying out more tests. Okay, for example, to reduce the detection risk from 10 to 5, the auditor needs to carry more tests, do a lot. In preparing the audit plan, the auditor needs to set out the overall level of audit risk, assess the level of inherent risk and control risk. Based on the outcome, then adjust the level of detection risk in order to receive the overall level of risk in the audit. Let me give an example. If let's say you're auditing a client and you have, from your assessment, you realize that there is high level of inherent risk, very high, because the business environment is risky, is volatile, is this and that. Then for the company itself, even the company is not helping because the organization is not okay based on your assessment, for example. So what this tells you is this: your detection, detection issue, you are going to do a lot so that your detection will be minimal. It means that instead of doing maybe vouching, sampling, you do 100%. Instead of doing online auditing, you do physical. Because you have discovered that, oh, detection risk is high, control risk is high, detection inherent risk is high, then it means your detection risk must be low. In other words, the detection risk can be managed by auditor in order to control the overall audit risk. Inherent risk cannot be controlled because it's outside what auditor can do. Control risk can be reduced by improving the quality of internal control, but is a company is going to affect next year's audit. There is the detection risk that the auditor have power over. The audit risk can be reduced by increasing testing and reducing detection risk. That is all about audit risk model. Any question? You can read more on it, read more on financial risk, business risk, audit risk. But financial risk, business risk, audit risk, and the likes. If there's any question, you can always drop it on the chat, on Telegram, as you wish. So we have few minutes left. Let's just look at one more aspect, the concept of materiality. Materiality in planning and performing an audit. There's a saying that materiality is relative. What does that mean? What is categorized as, let's say, the material in one situation and not be material in another situation. For example, an organization that has a turnover of, let's say, 300 million per month. Okay. And you discover difference. You are let's say checking receivables or revenue. You see a difference of 10,000. Oh, you don't waste your time on that, because 10,300 million doesn't make sense. It doesn't make is insignificant. But uh, a company that has turnover of 120,000 per month, 10,000 is highly significant. You should not let it go. That is what materiality is talking about. The materiality threshold. In order to deal with materiality on a consistent basis, most auditors set threshold. The audit staff are trained to use this threshold to measure whether or not an item is material. Materiality threshold may vary from one firm to another, but there is a threshold. Yes. For example, revenue. Some auditor might say, if you find a difference of 1%, 1% is a material issue, you should not let it go. Or 2%. The company, your audit firm might set it. So it will be part of your planning to know what you are going to vouch, what you are going to spend too much time on or not. Part of planning. You're going to plan how to spend your time also. Then pre-tax profit, there may be threshold on that. There may be threshold on the total asset. I think I have an example to this. There was a time I was auditing the company, and we have our materiality threshold. Okay, and this time around, I think it was asset. We've gone through everything. Part of the audit, you do physical verification, then the account balances, just check whether the computation, all those things to obtain your evidence. So when you are picking, because the company is big, we need to pick sample. We could not do 100%. So you just pick randomly based on figure. Of course, your plan is going to inform what kind of random you're going to do. Okay. Based on figure, I pick a figure. Part of what we're going to do, physical verification for, you want to see. This transaction is so big. It's so big that it just suggests, no, this is an asset. Let's pick it. Let's see. At the end of the day, we saw that item that was classified as asset was tissue paper. They bought a lot. Wow. For consumables. That's the essence of threshold. Because the threshold is, if an asset has reached a particular certain figure, we have to verify it. And that threshold helped that year to discover that an item that was classified as an asset was not supposed to be classified as an asset. I'm just trying to let you understand the essence of the threshold. It's very important. However, the materiality threshold has its disadvantage. Like, they measure whether an item is material without considering important factor as well. Other factor that auditor need to evaluate materiality, in addition to threshold, is nature of the item involved. Just like the example I just cited now, the significance of the item. Some items are so significant, they might not have big value, like big amount. The impact of the item on the financial statement. Those are the things you need to consider when for materiality threshold, the nature of the item involved, the significance of the item, and the likes. You can also read more on the ISA 320 materiality in planning and performing an audit. At the planning stage, the auditor must determine the materiality, yes, for financial statement as a whole, and the auditor must also set performance materiality. It is necessary. As the audit also progresses, the auditor needs to revise the materiality to be sure that the audit risk are reduced to the barest minimum. Then the use of computer in the audit, let's just look at it briefly. We have a few minutes. Let me check. Do you have any question? Any questions so far?
None.
Okay, thank you. So we just look at.
Sorry, ma.
Please go
I
ahead.
have a question.
Please go ahead.
Sorry, I will need to take you a little bit back to control risk.
Oh, please go ahead.
I didn't really get the concept, like in a nutshell, what is all about.
Yeah, control risk wow, I don't know what's going on. Getting echo. Hello? Better. Yeah.
I'm listening.
It is a risk that the internal control system in the client office is not effective to prevent fraud or to detect material misstatement. It is a risk. The risk that the internal control in the client's company is not effective enough to prevent or detect material misstatement. Do you understand it now?
Yes, ma.
Yes. Because if the client's office itself is not well managed, it means that there's a probability for uh, a lot of irregularities. For example, a company that the managers there, they don't come to work every time. The company that the people are not well managed, there is not organized, and you want to come and check how organized they are. You know you are going to do a lot. But a company that is organized, let's say a room that is organized and you just want to check things. Organized place, you can walk through and not be injured. But a place that is not organized, you are going to do a lot of things. That is how control risk is. If the control system in the organization is okay, the way there's a system, there's a control procedure, there's a procedure for collecting money, remitting, receipts, everything is managed by the company themselves. There's no lapses even from the company. It means it will be hard. The company are on top of their game to prevent fraud. But a company that they will just collect money, no receipt, they don't account for it, it tells the auditor that to verify that, oh, the figure they put on the financial statement are true, they are going to do a lot of things. That is why control risk is very important in overall audit risk. I hope that is clear.
Yes.
Thank you very much. Any other question,
Thank
please?
you, ma.
Any other question? Any other question? If there is no other question, there's a weekly question and answer for us on the topic we just discussed. You can go to the members area, chat the admin to have access if you don't have access to it, to check this week's question and answer for you to just look at how question can be set, maybe in the exam, to just familiarize yourself with it.
Hello, please. Good evening.
Good evening.
Please, concerning this member area, unlike the last lecture we had, I think as of today I've checked the member area, but I can't find the only thing I can find there is the video, that's the replay of the past lecture we had. But for the assignment or weekly question and solution, I don't find any there. I just want to get some clarification about that.
Okay, the admin will work on that. Thanks for that. If there is no other question, I think we can call it a day today. Thank you for coming. Thank you for joining. Hope to see you.
Please, sorry,
Okay,
ma'am.
please
And
go ahead.
a kind of though I made a plea on it last lecture, even on the member area, if it will be possible, or on the platform itself, if it is possible, whatever topic being treated, because normally on the member area one will normally see is that they'll just send us a question and the solution. But what I want to suggest, if it will be possible, maybe for instance, a particular topic, if Tarigo can help us to say, okay, on this topic, so question in this diet, this is the number, or a kind of reference to Finder as to the year the question was set and this and that. I don't know whether you understand what I'm trying to say.
I'm trying to understand.
This is what I'm trying to say. Let's say for instance on this topic now, maybe a particular question is being extracted from Finder. What I'm trying to say is this: if it will be possible, they should make reference to that. That okay, this is number 6 question in May diet. This is number 2 question in November's diet. So ye. So that maybe at least as we read, we also make some comparison.
Okay, I get your point.
All right, thank you.
Hello, because
Okay.
you get a valid point. But okay, I would just it would be nice if you can write on
Yes, it's admin.
the Telegram, so admin will see it and it will be so that they won't forget.
It's okay. All right. Thank you.
Thank you.
Thank you, ma'am.
Bye for now. Thank you once again.
Bye.
See you
Thank
next.
you. Bye.
Yeah, bye.
Thank you very much. All right.